All right, great. Thank you for joining us. We're going to talk about secret option strategies, how to select the best option trades in just minutes a day, put your trading on autopilot using a very user-friendly approach to trading options. It'll be new, I'm sure, to you. And even if you've traded options, there is something for you here. So our option traders love these secret strategies that we are going to talk about. So remember, we are speculators, and speculators accept risk, hoping to profit on price movement, just like Valentine and the Duke brothers there from Trading Places. So let's take a look at the risk disclosure before we begin. Take just a moment to read that. All right, the key thing there is all funds should be risk capital. Past performance is no guarantee of future results. All right, very good. So let's look at this. Jeremy Grantham. He was one of the few who predicted the 2008 crisis. He's suggesting in the next 20 years, real stock market returns will be 2 or 3%. So with that said, maybe we should consider looking at some alternatives to diversify our portfolios. That's what we're going to talk about. And here's Ed Sequoia, one of the market wizards. Great book if you haven't read it. There's also a part 2 to that. It says here, markets are always right, but we aren't. It can be very expensive trying to convince markets that you are correct. I'm sure you know the feeling. So maybe it's time for a new approach. Something that perhaps you don't need to have perfect precision with in terms of market timing or even market direction. So how about something new? Maybe it'll only take minutes a day, and we're going to talk about that. So for our agenda here today, a little bit about us and who we are, looking at the 3 common barriers to trading. How about stock market indexes versus individual stocks? We'll look at probabilities, high probability trading, have a live demonstration. That's really the meat and potatoes there. People love the demonstration. And we're going to have a special offer for you towards the end of the webinar with some FAQs as well. A little bit about AltaVest. We've been doing this since 1997. We are a brokerage firm. We're licensed, of course. We're all very experienced in doing this. We've traded millions of futures and options contracts over the years. We're regulated with the NFA and CFTC, and we're located in California and Illinois. Talking about experience, look at the graph there. There's the growth in the E-mini S&P 500 futures options. And that is what we're going to discuss a bit more deeply, and you'll see why as we get deeper into the presentation. So we've traded millions of these options, been a big part of that growth. So we have a lot of experience. We've learned a lot of things, what things that don't work so well, like this kid here is about to find out. But we like to look at it like Edison would, not necessarily failing, but found thousands of ways that don't always work. So who am I? I am Eric Gebhardt. I've been doing this about 28, 29 years now. I'm a co-founder of AltaVest. I've been licensed since 1991, and I have my BS in Business Administration from the University of Southern California. And I had an interest in options way back when in an investments course. We were studying at the time. I'll show you in just a second here where you can see the chapter there, 19, Introduction to Options Markets. Those are my notes there in my investments book. So it was very interesting, especially looking at crude oil at the time. It had doubled in value because of the invasion of Kuwait. And so that was sort of an exciting example to follow along during the class. I did become involved in the securities industry soon after graduation with my Series 6 and 63 licenses, but the futures and options markets kept whispering in my ear, so I was able to acquire a position at an options trading firm, and that's where I cut my teeth and learned the ropes on taking a much deeper dive into option strategy and spreads and volatility and so on and so forth. So we're going to continue forward here. Let's go ahead and put all of that texting away. I know we tend to do the same thing here. So be sure to take notes. We encourage that if you want to jot something down, you're more than welcome to. We'll use the time wisely together, and then we're going to jump into a live demo with a unique and new approach, and then we're going to have a special offer towards the end, something worth over $18,000. We'll show you how to get on board for next to nothing or perhaps even free, and we do also offer a 30-day guarantee. So with that said, I'm going to add more real estate to the screen here. I'm going to turn off the webcam. Okay, very good. And let's go ahead and look at those 3 barriers to success. This is what we think are the 3 barriers. We need to jump over these hurdles. Contradictions. That's our market analyst there in the entrance to our office. Fun little game everyone likes to play. He's not accurate on some days, maybe other days better. But here, for example, here's a recession, Morgan Stanley says. And the same day, Goldman Sachs here says there's reasons to keep buying the market at new highs. So who do you listen to? So all those contradictions. Now, what about past performance? Chasing that mutual fund performance or something called recency bias? Here are actively managed mutual funds awarded that coveted 5-star rating. Turns out that only 12% do well enough over the next 5 years to earn a top rating for that period. And the 10% that were 5-star then become 1-star. That's a great article in the Wall Street Journal, the Morningstar Mirage. So here's what it looks like. 5-star funds become 3, and then your 1-star becomes maybe a 2. So everything converges to around this 3 to 2 average range after a period of 3, 5, and 10 years. Interesting. So it looks like the S&P 500 has trounced active funds for a decade, according to Barron's. Only 22% of active funds, and that's out of 840 with 10-year records, beat the S&P this last decade. And only 5 value funds out of 241 beat the S&P. So as you know, the S&P has been on a tear. In fact, all stock markets have been, here in the US in particular. So is that going to continue? Hard to think it could. But really it says markets may not be efficient, but the probability is low that you can pick a fund that can exploit the inefficiencies. Great article in Barron's. So a little more about past performance. What makes it so difficult to pick winners? Well, it means you have to do so many things correctly all the time. There's so many variables involved. First of all, what's the market you're trading? What direction are you positioning yourself with what strategy? What is your entry timing, your price? And then how do you manage the risk and the rewards? Here's a fun little study. I remember looking at these things back, way back in school, really, doing the same thing, throwing darts and whatnot. But here's an article here from Forbes, simulated results of 100 monkeys throwing darts. Average monkey outperforms the index by an average of 1.7% per year. So there is the hedge fund manager of the year. Pretty good stuff there. All right, now what about one of the other elements here, one of those hurdles? Emotions. We become our own worst enemy. You've all been trading. If you haven't, still, I'm sure you get the point. We get anxious. We have some fear, some hope, some greed gets in the way, and we are all wired with a built-in bias to make poor investment decisions, to basically sell the lows and buy the highs. That's Head Strategy, Alexander Forbes Investments, Mark Lindheim. So we unnecessarily overcomplicate matters due to our human emotions. We need to be more like Spock, perhaps, when we trade with no emotion. And that's hard to do, but we're going to show you an approach that we use in just a second here. So time to simplify, break through those hurdles. Let's look at stock market indexes versus individual stocks. You all know what an index is. It's intending to represent an entire stock market. Here's the Dow Jones Industrial Average, the NASDAQ Composite, Standard & Poor's 500. Some of the big ones there you're all familiar with. We're not going to spend a lot of time on that, but it was the S&P 90 until 1957. Now it's 500 stocks like Berkshire Hathaway, Chevron, Coca-Cola, Kellogg, considered the bellwether representation for the U.S. markets and economy. And there's what the S&P 500 has done since inception. Obviously a strong upward bias there with the growth of the economy, and that's the way things are designed. but of course a lot of volatility along the way. So why would you track an index and not trade individual stocks? Well, first of all, they're convenient. You can follow just one or two indexes and not thousands of different funds and mutual, ETFs and so forth, and stocks, individual issues. And they're less volatile. A large move in a stock index might be 3%. Individual stocks move 10, 20% or more in a single day. A couple of examples. Here's Federal Express trading along, and all of a sudden it just collapsed here. I think that was some bad earnings. And meanwhile, the S&P 500 didn't even flinch. Here's the NASDAQ versus TD Ameritrade. TD Ameritrade had a very, very bad day there, at least for bulls, and the NASDAQ didn't even really notice. So I'm sure you've seen that, and there's also non-correlation. So here is the Visa stock, just looked at a random example here, one day up 1.24%. That same day, the Dow was down 0.35%, so they can move in different directions. Now let's look at insurance companies. How do they make money? Well, we know how they make money. We pay premiums to them. So they are paid to assume and manage risk. They sell and manage time, but they do hedge and insure themselves. They do have a business plan that involves patience and long-term odds and probabilities. They use mathematical probabilities to their advantage, such as these actuarial tables. I'm sure you're familiar with those. Statistics, expected returns, things like that. Let's look at some of that in relation to a casino or the house when we look at probabilities. A roulette wheel. There's 0 through 36, and then there's also a green 0 and a green double 0 for 38 numbers. Let's say you were to bet $100 on that green double 0, and you were to spin the wheel 38 times. Over a long enough sample size, you would lose 37 times and win once, winning $3,500 on that one winning spin. But the other losers, you would have $3,700 down the drain. So your net loss would be $200 or $5.26, and that is the house edge. So over a long run, that is the house edge. And they know that they can just keep playing forever and ever. And even though they'll pay out winnings at times, they still maintain that edge in the long run. So it's called the law of large numbers. The average of the results obtained from a large number of trials should be close to the expected value and become closer to the expected value as more trials are performed. So here's an analogy. Let's look at baseball real quickly. So we're talking about getting base hits in baseball. That's really a higher probability play as opposed to trying to hit a grand slam. I think you'd probably all agree with that. Here's Rod Carew, American League batting champion, and he hit no home runs. So he had lots and lots of base hits. Here's batting titles, MVP, so on and so forth. So what about using that same approach with options trading, high probability strategies, collecting those base hits? And we like to say that is what we call collecting premiums or selling options to collect the premiums. Lots and lots of base hits. So you need to be consistent and patient, manage that risk. You would expect to have losers, of course, but you have to manage the risk and reward, and you need the proper tools to make this happen. So remember, lots of base hits. We're not swinging for the fences here. So these are called credit spreads, where you collect premiums. These are insured positions, predetermined risk and reward, and they may be non-directional. We're going to talk a lot about that as well. Maximum reward on a credit spread is the net premium you collect minus what you've paid in commissions. And your maximum risk is the difference between the short and long strikes minus the premium received. Of course, you also factor commissions in there too. So an option spread, just to clarify, is multiple options combined at one net price, and they trade as an object. So, and I'll explain that in just a minute, but you have two, you could have 3, 4, 5, maybe 6 legs or different strike prices or different options, and combined, you look at the net credit, the net debit, and what's the result, and that's your net result of the spread, whether you pay money for the spread or you receive money for the spread. So here are credit spreads on stock index futures markets. These, of course, are less volatile than an individual stock, and the index may move a lot one way or another, but the value of your spread still may not be adversely impacted. And we will talk about that and look at that closer. Let's look at the Greeks. If you haven't heard of the option Greeks, that's fine. They're real simple. You can go actually pretty deep in the weeds on these, but there's no need to. It's really not applicable to what we're doing, but we're going to have just a couple Greeks here we're going to look at. Super simple. Here's delta. What is it? It's the percentage change in option value compared to the change in the underlying asset. So what do I mean by that? Let's say the S&P is at 3120. You've got a 3090 put at 15 points. The delta is 0.25. And let's say the futures contract drops 10 points to 3110. What happens to the value of that put option? Well, it gains 25% because of the 0.25 delta, and now it's worth 18 3/4 when it was worth 15. Just that simple. So at the money, deltas are 50%, deep in the money 100%, and deep out of the money might have a 1 or 2% delta, very small. But here's the real key, the secret to delta. It also equals the approximate probability of expiring in the money. So a 0.25 delta means there is a 75% chance that the option expires worthless. It's not static. Remember, that delta always moves as prices move and as time goes by. And it also does not represent the probability of a winning trade. So let's look at time. The market might move against your spread. And that means basically in the wrong direction, or maybe too much of a good thing, too much movement. But yet the value of that spread may not be adversely impacted. That's because of time decay, and that's called theta, or sensitivity to time. Remember, options are all a wasting asset with a limited lifespan. So theta is a negative number equaling 1 day of time decay. So if you have an option premium of 10, theta is negative 0.05. The next day, all other things equal, you would now have a value of 9.95. The next day after that, 9.90, and so forth. So unless the underlying asset is moving favorably and quickly enough, every out of the money option is 0 at expiration. And this is the theta decay, and what gives these credit spreads or selling options the wiggle room we talk about, taking advantage of that theta decay. So you can see here, as time gets closer to 0, the percent of the premium remaining on any option starts to approach 0. So really, we're trying to be as low-key and boring as we can get when we're selling options. We don't want a whole lot to happen. We just want to watch time pass. That's the whole goal. But of course, it's never that easy. And we're going to talk about how to manage risk and reward. So here's an example of a credit spread, selling a call spread, bearish to neutral. You collect premium by selling a call, and then you buy a higher strike call to limit risk. And here's what it looks like. Here's the S&P trading along, up and away, right around 33.30 or so here. And you think, well, that's great. It's in an uptrend, but I think maybe it's going to pause for a bit. It doesn't have to necessarily go down, but maybe it'll just chop around and go sideways, or maybe you're bearish. So you decide to sell a 35.30 call, and you receive 4.5 points for selling that call. And how do you sell a call? Simple. You just use your mouse and click sell. Just that easy. It's not complicated. That simple. So don't get confused. And if you want to buy an option here above it, the one you sold, here's the 35.50 call, 20 points above it, and you buy that option as a hedge or for protection, but you pay 2.25 for that. So the net premium is 2.25 points, $112.50 minus your commission. So that's the money that you collect for selling this out of the money call spread in this example. And then here's a put spread, the opposite here. So Once again, the S&P has been trading up and away. Then maybe you think the market's going to keep going up. Or maybe you think it might even just slow down a bit, but you're not expecting it to really fall apart and crash through the floor. So you sell the 29.90 put, out of the money put, collect 3 points, and you buy simultaneously the 29.70. You pay $1, net premium $100 that you collect, of course, including your commission. So that is how that works. And remember, these are not naked options. These are insured. Your maximum risk is capped, and these are called covered option spreads. This cat probably wishes he or she had some covering, but no naked options. Here's what happens. This is why. Here's the S&P 2800. You decide to sell a 25.85 put represented by the red horizontal line. The market keeps dropping and dropping and dropping and dropping. You're still short this 25.85 put. You're sitting on a loss of almost $12,000 if you were still short that put, that naked put. Now, had you bought the 25.65 put at the same time, then of course your maximum risk would be no more than 20 points. In fact, a little bit less. But big difference there. You're risking, in this case, no more than $1,000 when you have a covered put spread that you sell. And in this case, selling the naked option, you ended up risking almost $12,000, or even perhaps more if prices kept dropping. So remember, only covered strategies, that's all we're talking about. No naked options. And remember too, no margin calls when you sell covered options, because you know your risk in advance. So you will not get a surprise call from your broker about a margin call. So that's pretty cool. Let's look at something called an iron condor, non-directional strategy. So you're thinking, how do you make money if there's no direction involved? Well, it's the combination of the put and the call spread that we just looked at. And we like to apply this on a stock index like the ES or E-mini S&P 500. Here's what it looks like. Very simple. Excuse me here. There we go. So you're selling an out-of-the-money call spread above the market and out-of-the-money put spread below the market. And you can see the market just chopping away, going down a bit, going back up a bit. And meanwhile, you've collected premium by selling both the call and the put spread. And that's what a condor looks like. Now, if you've heard of condors, here's something you probably haven't heard of. A dragonfly, something actually we created. It's a variation on a condor. Let me explain this to you with a graph. Makes it a lot easier. So here you can see there are 6 legs to this spread. 3 puts and 3 calls. And let's look at the calls, for example. You sell 4 33.30 calls, and you buy 3 further out of the money calls, and you buy 1 closer to the money call. And this call here is the 32.90. The calls you sold are 33.30, so those are 40 points. This one that you buy is 40 points closer to the money. And then with the puts, same thing. You sell 4 puts, you buy 1 closer to the money, and buy 3 further out of the money. So for every option you've sold, you are long an option with the puts, and the same thing with the calls. So those are covered. And the reason you do this, and we'll show you in the demo, is that this option here that's closer to the money with the call and this closer to the money put actually holds its value quite a bit more because it's so much closer to the money than the options that you have sold, and it won't lose time value as quickly. So we can take a deeper dive in just a moment. There's also, half dragonfly spreads. So you can just do one side or the other of a spread, whether it's a condor, just a typical call or a put spread, or in this case, here's a half dragonfly call spread. Here's the S&P trading away, sitting here, and you decide to sell this out of the money half dragonfly call spread. Once again, selling 4 calls, buying 3 above it, and 1 below it. So that is the structure. There's also something called a bear hedge that we put together with what we're doing here. So you're essentially selling an out-of-the-money call spread, and then you use that money that you received to buy a put spread. So maybe you think the S&P is ready to drop. Maybe you think it's overextended, overbought, RSI's overbought, whatever it is you're following, and moving averages or something or crossing, and you sell an out-of-the-money call spread, collect premium, then you can use that premium to finance and purchase and buy an out-of-the-money put spread. So if the market does drop quickly enough, the put spread you buy is likely to increase in value, and the call spread you sold is likely to decrease in value, which is, of course, the goal of selling the spread. You want to sell something, in this case, maybe it was 2 points for the spread, and maybe you close it out for 20 cents or something later on. So there you have it. Now, options can be complicated. There's so many to choose from, so many combinations, permutations. So how would you even know where to begin? Here's just a quick little run through. Here's a CME website looking at some E-mini options. You can see the calls and puts on the left and right side, all the different strike prices available, all the different pricing. And how would you even know, where to begin in terms of which options to choose and what's a good value and what's the correct pricing and so forth. So there's a lot to it, but we have something that can make it a lot easier. And remember, ES options trade weekly, Monday, Wednesday, monthly, quarterly, end of month. Lots of opportunities available. But once again, how do you know which ones to trade, where to start, what do you sell, who are you selling to, where do the premiums come from, the who, what, when, where, why, all those questions, managing risk and profits. So you need to be able to consistently automate your risk and profit management. You need to be non-emotional, and you really need to keep it simple. So we're looking at high probability strategies over and over again. Like a shampoo bottle says, "What your hair and lather, rinse and repeat." So you just got to do that over and over. You got to use the right instrument. We're using liquid ES options. We're using automation for risk and reward. Also, position size. You don't want to be over leveraged. You have a $100,000 account. You don't want to put, $80,000 of your account into one trade. That would be ridiculous. Very, very aggressive. And you want to stagger, what we call ladder, your strikes and expirations. So hopefully we're not too perplexed after going through that. So we have the testing behind us. We've done all the work for you, taken something complex, and we've made it very simple and user-friendly. It's called Theta Trader. It's for selling time, collecting premium, pre-built credit spreads. So that is the secret sauce here. Pre-built credit spreads. Proprietary algo will build what we call theta trades. And these are the same strategies sophisticated traders use. Bull, bear, and flat markets like we saw, non-directional strategies. And then we can automate risk and reward with something called the RTI, color-coded risk thermal indicator. So if you like what you're going to see, we're going to show you how to take action. So with that said, let me switch gears here, and I'm going to share my Theta Trader screen. Okay, there it is. This is the dashboard for Theta Trader. So here is what you would see if you log into Theta Trader. And we're going to go through this and get right to the heart of it quickly. So you can see the theta trades, and I'll show you that. Here's current open short positions or sold positions. You can see dragonflies and condors and so forth listed. Here's any open long or bought positions. Theta Trader will buy spreads as well. Here's account info. This is just a demo account, so don't pay any attention to the numbers, but if it were real, this is where you'd find everything. And then quotes for what's happening during the day. Now let's start up at the top here looking at the theta trades. You can see if you click bullish, all of the bullish strategies populate. Same thing with bearish and neutral or non-directional. And then three primary markets, the ES, the NQ, which is NASDAQ Mini, and the RT, the Mini Russell. So we do have trading available in those markets, but primarily, most of the volume of late has been in the ES. And let's take a look here since we looked at condors and dragonflies. Let's look at today's condor. So you click that, you can see anywhere from 16 to 64 days of time with any of these particular condor spreads available. And where do these come from? Well, the algorithm selects these and picks these trades. And you can see here, this is your maximum profit potential for any particular spread with a quantity of 1, and then targeted annualized return at expiration. So you can see how the shorter dated trades with only, in this case, 16 days versus 64 days has a much higher annualized return. That means you just hold it, of course, shorter, and you would assume, this number just assumes you place the same trade over and over for the year, but that is not realistic. You can't expect these returns. These TAR numbers are only here so you can compare one trade to another. So compare, the different days till expiration across the different time frames there. So with that said, let's look at this particular trade. So here you go. The first thing I like to do is look at the chart. So you can see here, selling a 3460 call and buying a 3480 call, and then selling a 2860 put and buying a 2840 put. And that's what that trade looks like. Market's trading right around here, selling out of the money calls and puts on that condor. If you want to look at just the calls, that's what these calls look like here. And here are the puts, all pre-populated. Now, if you want to look just at the condor, let's take a look here. 64 days till expiration. This spread settled at 2.6. $130 is the net premium. Your maximum put risk and call risk is $1,000. Your commission, your available capital, your cash required, and then here's your profit potential. And I want to point out too that all these numbers and all these percentages are net of all commissions and fees. So keep that in mind. But here's a question. Why would you risk $891 to make $109? So that is going to lead us to the delta. Remember we talked about high probability. So here the 2860 put that you're selling has a delta of 9.89. And that really means that there's over a 90% probability that the option will expire out of the money or expire worthless. And the call you're selling, the 3460, the delta of 6.65, once again, about a 93, let's say 93% or more probability that the option will expire out of the money. So those are high probability trades that we talked about. Remember base hits. So that's why the algorithm has chosen these particular trades. It looks at some other variables too behind the scenes and behind the curtain, but the delta is one of the key aspects when we're looking at these trades. So you can look at your total return on cash, 12.2%. And you can see here it's pre-populated as a sell because we're selling an iron condor. The quantity always defaults to 1, but let's just try something different here. Let's say, I don't know, 6. And we're going to leave the price the way it is at 260. And notice when I hit 6, it changed the cash required just over 5,000. So basically each condor, when the spread is 20 points between the sold and the long position, you can count on about $1,000 risk, maximum risk per condor. And you can see the net price here. If you want to add discretion, that means if you're willing to get the order filled at, let's say 250, you could add that in here. But let's go ahead and place that order. All right, there you go. It's right here, 260. Demo account just assumes you're filled. Now, let's point out something here. There's also something called a simulator. And I've loaded up some simulations for the sake of brevity here. And I'm going to demonstrate how this works. This is a lot of fun, actually. So you can see here, this is an Iron Condor, September 25 of last year. And let's go ahead, you use these buttons to move forward and backwards in time. So let's go ahead, I'm gonna hit play. So day by day, the market's trading, and you can see here, this is the RTI, the risk thermal indicator, and every day so far it's been green, which is good. It means do nothing. Theta Trader says just hang on to the trade and do absolutely nothing. And you can see now the P&L on this trade is turning green or profitable. And why is that? Well, the market's just kind of going sideways, and theta decay is working. Those positions are losing time value, which of course, when you're selling an option, spread is what you're after. And then look here, it turns blue with 37 days left. And what does blue mean? It means take profits. So Theta Trader has triggered a profit taking signal. It says to get out. And now here's something really, really interesting. You can automate this. And I'll show you how to do that, but you don't even have to watch it. Theta Trader can place the order for you when it turns blue and tells you to take profit. So you can automatically have Theta Trader take those profits for you and also manage risk, and I'm going to show you that. So there's an example of a typical iron condor. Now let's look at another iron condor. We could do this one step at a time like this, or you can go backwards, or just like to play it. So you can see here, once again, the RTI is green. The market's starting to, oh, look at that, turns blue. Once again, take profits on the trade and move on to something else. But what would happen, I know sometimes people say, well, market's quiet, I don't want to get out now. I've captured 70% of my potential gain, but I want to get 100%. I want to collect all the premium. So I'm going to stay in the trade and hopefully it expires worthless. So let's see what happens. Turns yellow. So Theta Trader is kind of giving a caution signal here because it's getting closer to this upper boundary where you sold that call. Goes back to green again, goes to yellow again. So you can see what's happened here. The trade was green, profitable. Now the P&L has turned red. And look at that. It turned red and signaled too much risk, get out, take your loss and move on. So it's important to follow those signals that RTI issues and Theta Trader issues when it says to get out, whether it's for a profit or a gain. You don't want to take a winning trade and turn it into a losing trade, which is what could have happened here. So here is something else I want to look at on the condor. Then we're going to look at the dragonfly. Here we go. So really nothing to see yet. The trade is all green. No trouble. RTI says fine, just sit on it. But now it's getting a little dicey. It gets yellow and then it goes to red. And that means get out, too much risk. It's getting really close to that upper boundary. You don't want to be in the money on that. And so that is interesting. So there's 16 days left and it says to get out and take your loss. And it doesn't really matter what happens afterwards. It would have turned out okay, but that's all hindsight. You know, we can't trade with hindsight. Nonetheless, you can see how this condor trade was also a loser. Said get out at 16 days. Now what I want to do is show you a dragonfly. And before I do that, I want to show you how a dragonfly works on the dashboard. Okay, so let's go ahead and look at a dragonfly. This might help when we go through the simulation. So here's what that dragonfly looks like for today. Today's Theta trade on this particular March end of month expiration. Selling the 3460 calls and the 2860 puts. You're selling 4 of those each. And you're buying 3 of the 3510 calls and buying 1 3420. And then you're buying 1 29 put and 3 2810 put. So that's what it looks like on the graph. So you can see here your put risk is 5,500, same as the call risk. Cash required is just over 5,100. Profit potential on that almost 400, and your targeted return on cash 7.5. Remember the condor was a little over 10, I think. So the dragonfly will typically have a lower total return on cash, and probably a lower, just a lower risk trade in the sense that I'll show you how it works in the simulator, but you're not going to typically target as large of a number with a dragonfly, and that's not good or bad or worse. It's just different risk and reward character trait from the condor. But we do like the dragonfly a lot. We're trading a lot of those. So you can see here the delta 9.89 and 6.65, and those are the same strike prices on the condor that were sold. And you can see here it's defaulting to selling a quantity of 1 at a price of 9.35. So each one is about $5,000. Let's go ahead and leave that quantity at 1. And let's say we placed a trade. And there it is, filled at 9.35. So let's go back and let's look at the dragonfly here. Remember, we just looked at this condor, and it ended up taking a loss on, let's see, what 16 days till expiration. Let's see what happens if you had done a dragonfly on that same particular day. So everything's green, everything's fine. Look at this, with 29 days till expiration, it turned blue. The trade turned profitable, and that is because this option here, the 32.90 call, represented by the blue line, you had actually bought. You were along that call. So as prices have gotten closer and closer, this call is gaining in value quicker than the out-of-the-money calls that you sold. So that is the difference with the dragonfly. And I don't remember what happens. It doesn't really matter. Turn profitable anyway. But so big difference. You can see here, this actually was a losing trade. But had you placed a dragonfly on that same day, you would have been able to pull the plug and take money off the table and move on to something else. In fact, you can see here the percentage of the premium captured at settlement on these days is actually greater than 100%. So that can happen sometimes because, once again, this call, for example, is closer to the money. In fact, with the market trading up above it, it's now in the money. So it has quite a bit of value. So let's look at another condor here. Let's see what happens and compare that to a dragonfly. This is from last year, about a year ago. Interesting. Okay, that was a slow ride, wasn't it? It's kind of gradually edged higher and higher and higher, and eventually turned profitable according to the RTI with 2 days till expiration. So let's look at a dragonfly. Same date, February 14 of last year. See what happens. Okay, did I see that? That came by quickly. Look at that. It turned profitable with 34 days till expiration. So the dragonfly, compared to the condor, you had to wait and hang on to that trade until there were 2 days left. But with the dragonfly, you would have triggered a profit signal with 34 days till expiration. So that is a key difference and a key distinction between the dragonfly and the condor. They will act completely differently depending on market conditions. We like the condors a lot for certain things, but we actually think the dragonfly gives a bit more staying power, perhaps is the word I'm looking for. Now let me show you where to find how to automate that RTI. You just go to your My Account, click the settings, right here, activate your risk manager, and activate your profit directive. You just check those boxes, and that's all you need to do. Then ThetaTrader can automatically manage that risk and reward for you. Also, let me point out we have proprietary research something called Trade Scope we do every day. With technical analysis, we look at some of the averages and MACD and the RSI indicators. And then we have an outlook here for technical review, market outlook, and then what to look forward to in the weeks ahead. So that is great proprietary research. We also have a daily narrative summary of the daily activity around the globe. So you can see here what's happening in China, what's happening in Europe, economic reports here in the US, what to look forward to in the weeks ahead, some technical key support, resistance areas, earnings, and whatnot. So that's all available as proprietary research as well. And then I want to point out education. We have videos here if you need a review on some of these option spreads, and we have tutorials. So if you ever get hung up a little bit using ThetaTrader, there are video tutorials, but quite frankly, it is very intuitive, very user-friendly, and very easy. So I don't suspect you'll have any trouble with that. Now, you want to look at your open positions. Here's a key component to ThetaTrader. If you're trying to trade with a typical brokerage and look at your brokerage statements and figure out what spreads you have on and which ones are at what value and whatnot, I mean, it's just impossible. But look how easy this is. Each one of these lines represents one spread, tells you your entry date, gives you days till expiration, and then here, at a glance, you can see what the RTI is telling you. This means all good, nothing to do on any of these trades. And if you want to drill down, look at any one of them, I don't know, let's say this particular condor, you just click on it, and there's the graph, the history of what that trade has been doing. You see the settlement history day by day since January 7 on that particular trade. It's all green, all good, systems go, nothing to do on that. Just watch time, fly, so to speak, watch that paint dry. That's the whole point of selling these options. So look how easy that is with your open positions. And of course, if you go to your dashboard, you can see all your open positions right on the dashboard on your cover page, so front page, so to speak, right at a glance. Super simple. And then if you want to look at closed positions, that's easy too. You can see your trade history all here. You can filter it any way you want through any dates you want, and see here all your closed trades. Super easy, really simple. I want to point out one other thing too here called Trade Builder. So if you want to start from scratch and just build your own trade, select the market, strategy, and then just move forward, follow the prompts, and enter the quantities and so on and so forth. But really, most people are taking the theta trades. They're following the algorithm and what the algo says to do, and that's the whole point of ThetaTrader, taking something complex and making it super, super simple and friendly. Now here, I'm going to get to the best part of ThetaTrader. So just bear with me as I switch screens. So as great as that was, it gets even better. Let me show you. Maybe you need a little breather after taking all of that in. Seems, like second nature to me because I use it so often. But if you've never seen it before, perhaps you might think, wow, that's a lot of material. I'm getting a little overwhelmed. Well, don't be like Lucy and Ethel because we're going to make it even easier. Here's our best feature. 1 minute trading with these trade alerts. These are one-touch trades. You receive an alert on your phone, you touch accept or reject, and then we handle the rest. It gets processed for you. So these are live alerts. They're integrated with your trading account with ThetaTrader. So you do not need to log into some separate third-party platform and try to transpose the information from the alert into a separate program or platform. And then you saw how ThetaTrader can automatically track and then manage any position that's filled with the RTI. So let's take a look here. There's a little animation. Just that simple. Gives a little explanation. You see a graph of the trade. Gives you the cash required. The quantity is already pre-populated. It gives you the data, days till expiration, targeted annualized return, and then you click accept, and that's it. So let's take another look. You get a alert. You just touch that link, that hyperlink, takes you right to the alert. Gives you everything you need to know about that trade. You know, what is the risk, the cash required, what's your premium collected, what's the quantity, and you just touch accept, and then we handle the rest. I mean, it doesn't get any better than that. We have, I mean, quite frankly, we've had airline pilots from the cockpit, people golfing, people on vacation. It's kind of funny to hear all the stories. Oh yeah, I got that alert. I was up in the cockpit, or yeah, I remember got that. I just touched accept, and you know, we were on a cruise. I mean, very, very convenient. So remember, screen watching, it's not cool. You want to do your own thing. Don't sit behind a screen. You'd rather be doing something with your family, your friends, and we know you have a life to live. So was this time well spent? I think you discovered something new and valuable. So here is the special offer with everything you need to get started now that you know you have found your options trading solution. We have the Pro Trader and the Elite Trader. There's two different ways you can do this. So let's talk about the Pro membership. You, of course, get the Theta Trader platform with all the Theta trades every day, as you just saw in the demonstration. The proprietary algorithm will pre-build those spreads for you. Simple and effective. No more struggling with trade selection. Now, how about trade tracking? Would you rather look at this to see how your trades are doing and look at the RTI, or would you rather try to figure this out? And I've been in this since 1991, and they haven't changed the statements. They are the worst possible and least friendly to use, especially with spread trading with options. How about the RTI? Automatically exit trades on autopilot, non-emotional. So that's how you do it there. I showed you. Activate the risk manager, check the box. That's it. Profit directive, check the box. Then you're on the RTI. The computer, the algorithm does it for you. Let technology make things easy. Trade simulator. That's a really, really fun thing to use. Go back in time, press play, or you can just go press the button there at the end. It takes you right through it in 1 second. You don't have to watch it play out. But that's a real convenient way to gain some insight onto how trading any of these strategies would have worked during any particular time window. Then Trade Builder, you saw that. So you have Theta Trades, the RTI, the simulator, and the Trade Builder. Yearly value for that software of $35.88. I know people spend a lot of money on software. I talk to them every day. I hear about what they're doing. I get it. Now, how about those trade alerts? They're integrated with your account. Remember, you just touch accept or reject. These trades are tailored for your account. The quantity is pre-sized, and then the RTI can automatically take it from there. So that's all part of your Pro membership as well. Yearly value for that, $44.64. And believe me, like I said, I know people spend a fortune on these types of alerts. And once again, how do you activate those alerts? Similar to the RTI, you just go into the settings and you just check those boxes, and that is all it takes. So with your Pro membership, you get the Theta Trader platform, the trade alerts, a value of over $8,000. So if this Theta Trader Pro could allow you to trade in ways you never could have done before, trade something complex and make it really simple, cut cost, cut the aggravation out of it, I think it would be worth it. This guy says, you betcha. That's a big yes. But remember, we offer the proprietary research. We have TradeScope and that daily commentary, keep you informed. And that's available through the Pro membership as well. Yearly value $29.52. Then we have, of course, the tutorials as part of the Theta Trader platform. We have videos there built into Theta Trader, all available for you there. That's just a bonus, of course, with the tutorials and education. Yearly value of over $11,000. So even at half price, that would be a great deal. $5,000 for all of that. Absolutely, it would be. But I think we can do better. We can use that, what's that word they say, over deliver. So we're going to over deliver for our webinar attendees. So if you're ready to hit the ground running with Theta Trader Pro, you love Theta Trader, you love the Theta trades, you like that simulator, you like the RTI and the trade alerts and everything else, you want to get started. One-time payment to get started, $497. You see the link there, cf.altivest.com/pro-TT. But here's the thing, we can do better. Why don't we just make it free? Get yourself started with that pro membership. There's the link, there's the phone number. Call us anytime, but quite frankly, most people just use the link, sign up, get things processed, just like you would with any other brokerage firm, and we'll get you started and get the show on the road. So what kind of deal is that? Free. So sometimes my dad will joke, oh, that's too much, so here we are. It doesn't get any better than that. Now, here's really the key to this, though. There's an elite membership, and that means you get a private coach, a mentor, a tutor, whatever word or term you prefer to use. So someone who's licensed, experienced, can work with you side by side, and we offer 1-hour sessions on all the different things we talked about, option strategies, index selection, different theta trades, the simulator, diversifying and laddering those trades, your setups, analysis, some of the trade alerts, and some advanced option strategies beyond what we talked about, because there are some other things that Theta Trader can do that we didn't show you in the simulation. You might have gotten a glimpse of it, but we can't spend hours and hours on these presentations. So there's a lot there to use, and you have someone to train you. Onboarding, you get a co-pilot, you have a relationship with a licensed trader, someone with decades of experience. A value of really $7,500 is too low. I know there are educational firms out there. I see them advertise. I've been to through their materials. I've been in attendance at some of these events, and they'll charge up to $25,000 to learn how to trade options. And that's good and well, but perhaps you can learn what you need to know with Theta Trader. So remember, we talked about the pro membership, but how about that elite membership with all of that coaching and training and mentorship available? One-time payment. This is not a monthly thing or quarterly or yearly. $997, but here we go. We'll do better. Take 20% off, $797. So this is not one of those typical things where you sign up and all you do is type on a keyboard with a chat bot. This is real people, real life. This is something that a lot of brokerage firms don't even get involved with anymore. But you see the link, cf.altivest.com/TT Elite AV. So that's what it looks like. That's the screen, just simple. Type in your info, submit it. We'll get you that elite membership started right away, get you onboarded, and you'll be well on your way towards using Theta Trader in no time at all. There's a 30-day guarantee on that membership. So if 29 days and 23 hours and 59 minutes go by, you decide it's not for you, that's fine. We'll refund your money. No problem, no trouble, no questions asked. And remember, it's a one-on-one style of service. I sort of alluded to that earlier. It's unique. A lot of people aren't doing this. And it's one of those things where it's a boutique style of service. So we quite literally can't handle, tens of thousands of people doing this. And one-time payment, $797. It's a great deal. You'll want to get on board with that and get assigned to your private mentor. Now, if you want a free elite membership, sure, we can do that. $100,000 or more account, we can refund that membership fee. Be glad to do so. Ask us for details. Now, trading account types, we're going to get into some interesting things here, so stick with us about FAQs. IRA accounts, yes, people always ask, can I do an IRA? Absolutely. And then, of course, individual, joint, corporate, LLC, trust, all the usual types. Here's a little segment we call I Bet You Didn't Know. So ES, futures and options. What are the advantages? So why do we trade just the ES as a primary focus? In every trading scenario, ES futures contracts offer a cost-efficient way to manage S&P 500 exposure compared to ETFs. There's the article there from the CME group. So that's interesting. The ES futures are cost efficient. They offer significantly more daily liquidity at 8 times the value of all S&P 500 ETFs combined, including the SPY, the IVV, and the VOO. All right, well, that's great for futures, but we're trading options, right? Well, let's take a look. Traders are fleeing the individual stock options markets. Here's a Wall Street Journal article from, let's see, about 2 years ago, something like that. We've seen customers pulling out of equity options, trying to trade other products. Customers are shifting to futures contracts. The OCC data show a 42% increase in futures volume in April. That's interesting. And it says the bid-ask spread has grown 30% in the past 5 years, peaking in 2014. So he's talking about the individual options market and the spread in that particular space. So you don't want that spread to be wide. You don't want it to grow. You want it to be tight and narrow. So let's look at that. So ES options have tight spreads. Look at the quality of execution. There's an article there from the CME group. You can see the link there. It says here they offer superior execution on average, and in dollar terms, they offer cost savings of $4 to $15 per contract with the ES options. So that's what we talk about here with the spread, the bid and the offer. You want that to be narrow to lower your transaction cost. Now remember, at the CME group, these E-mini, these ES options, when you trade a spread, it trades as what they call an object at one net price. So in securities trading, when you trade a spread, they don't have the same advantage, and they don't trade as an object like they do with the ES options. There is also hidden cost in securities trading. You've heard of free stock trading? Well, remember your parents, grandparents always told you there's no free lunch? Well, it's true, there isn't. The cost of trading at these free stock trading places is very opaque. There's something called payment for order flow. Let me explain that. So stock brokerages are paid by third-party market-making firms to route their orders to them for execution. The retail order can be ripe for exploitation. So market-making groups, there's large ones like Citadel. And let's look at what this means. Can result in less favorable fill prices to the retail trader. So yeah, they say it's commission free, but you got a fill price that was worse, and maybe that slippage cost you even more. So, but the cost is buried in the transaction. You don't see it. It's not visible to you. So look at this about Robinhood, making millions selling out their millennial customers to high frequency traders. They're well on their way to making hundreds of millions of dollars in cash income by selling their customers' orders to the high-frequency trading meat grinder. High-frequency traders are not charities. The only reason high-frequency traders would pay Robinhood tens to hundreds of millions of dollars is that they can exploit the retail customers. There's an article from Seeking Alpha. So those are hidden costs of trading stocks. So remember, there's no free lunch. Here's another one. This is I don't know, this is kind of rough, a little bit harsh, but kind of have to chuckle. Schwab and others confirm their status as casinos, the purveyors of financial opioids. There's no such thing as a free lunch. Retail stock brokerages are not charities, and they will absolutely make up lost commission revenues in other ways, usually obfuscated way down in the guts of their workflow processes where few people notice. So I would have to agree. There's nothing free about it. And that's from an article in the tab forum there by Paul Roaday. So remember, with E-mini options, ES options, these are futures options. These are not security options. They trade separately from what we just talked about. These trade at a totally different exchange at the CME group on the Globex electronic exchange. There's no payment for order flow. There's none of that quote free trading nonsense. And once again, it's an electronic market for all, trading on Globex. Doesn't matter if it's 1, 2, 3, 5 options or 100 or 200 or whatever, all orders receive the same equal treatment on the Globex exchange. And I bet you didn't know about tax efficiency. When you're trading futures options, they're subject to the 60-40 tax treatment. So 60% of the gains are taxed at the lower long-term capital gains rate. So what does that mean? If you're trading individual stock options, $100,000 account, 20% return, you're in the highest tax bracket, you're going to pay $7,400 in tax, 12.6% return. Now, same thing, trading ES options, $5,360 tax liability. Your return is 14.64%. So just because of the favorable tax treatment with ES options, you have a tax savings of over $2,000. Pretty interesting. Now remember, losses can be used to write off other gains or roll backwards. Consult your tax advisor for details. And also, there's no more itemizing. None of those wash sales and messy, accounting that you have to do with trading in the security side. You just get a number, your P&L on your 1099, you plug it into your taxes, and that's all you need to do. So we are welcoming you to our family here, welcome you to become a client. And to do so, you can act now and get lots of value in return. You don't want to do nothing. That's 100% risk and reward free. Now you've seen everything Theta Trader can do. You know that a membership equals tremendous value. You get that elite membership with that private coaching. Or if you want to just take the ball and run with it on your own, that's okay too. That's Theta Trader Pro. Real quick summary of the advantages, and I have a few more FAQs. Remember, we're using time decay with high probability strategies. These are pre-built trades with an algorithm, and then the automated risk and profit with the RTI, those one-touch alerts. Trading in all market conditions is tax efficient, helps to diversify your exposure with non-correlated assets, and you can follow just one or two indexes, not worry about thousands of different stocks. So remember, Theta Trader with the private training, with the trade alerts, you get the guidance of trade scope and the commentary, you get all the education, tax advantages, and that leads us to the FAQs. Here's a question we still get. Can I trade stock options with Theta Trader? No. Remember, we specialize in ES options and essentially the E-mini stock index futures family. And you saw and read and heard a little bit as to why. Remember the high growth and volume, the liquidity in those E-mini markets, and the E-mini options have tight spreads. You can track just one or two markets, and they have a clear cost structure. It's not opaque. There's none of that nonsense. So can I use Theta Trader and the alerts with my current brokerage? No, we are the brokerage firm that developed it. It's our proprietary service and integrated with what we do. And what is the performance of Theta Trader? Well, Theta Trader is just a trading platform for self-directed clients, and they make their own trading decisions. And as a reminder, I pointed that out in the demo, all the performance calculations within Theta Trader, those are also net of the trading costs involved. So that begs the question, what are the trading costs? Our rates are very competitive. So our E-mini rate is 5.25. That's round turn, all in. So other rates you might see published at big sites that'll say $2.25, but read the fine print. That'll be per side. And then when you add more fees on top, like clearing and exchange fees, look at the fine print, scroll to the bottom, their total can often be higher than our total. So if you buy an option and you sell an option with us, it's 5.25 period for the entry and the exit total. If you go somewhere else, you pay 2.25 plus some additional fees when you get in, and then 2.25 plus additional fees when you get out, and the total can be higher. So our rates are very competitive. And of course, we offer a totally different level of service than those other brokerage firms do as well. So how much money do I start trading with? We saw that 1,000 for one ES Condor, the way it's structured right now with the 20-point spread, and then about 5,000 for an ES Dragonfly. So if you want to simultaneously have different trades diversified among various markets, strikes, expirations, whatnot, we suggest a minimum $25 to $50,000. Let's see here. So that's the end of our FAQs. So we talked about taking action. If you liked what you saw, here is your opportunity. Data Trader Elite, that's just one time, $797, and there's a 30-day guarantee. You really have no risk in trying that out. And then Data Trader Pro, if you want to do things on your own in more of a self-directed manner. So we talked about crossing those hurdles, getting in the way of our trading. Talked about contradictions every day from pundits. You don't have to worry about that here. We're not paying attention to all that nonsense. Chasing performance, we don't worry about that here at all. What we're doing is an absolute return approach to trading. We're not comparing ourselves to any benchmark. And then emotions, we saw how the automation and the technology and the algorithms within DataTrader and the alerts make things so easy. You can wipe away those emotions from your trading. You can get out of your own way. So here it is, lifetime membership with that Theta Trader Elite, $797, just one time. It's not monthly. I don't want to repeat myself, but we get that a lot. It's not monthly or quarterly, just one time, or Theta Trader Pro available at no cost. So those are the links right there. And that'll do it. Thank you for your time. Bye-bye.